Sustainability is increasingly on investors' minds. Money is pouring into ESG funds, where priority is given not just to financial performance, but also environmental, social, and governance factors of a company.
And in such a complex and difficult time, ESG, using it as a lens to investing, is going to become much more important, because companies that embrace and do well on ESG have strong leadership as well as higher productivity from its employees, but also very importantly, they are less likely to breach environmental issues. And as a result, they are better able to adapt this very complex environment and would likely do better than those that don't.
It's estimated that by 2025, ESG investments will reach $53 trillion. That's a third of global assets under management. For now, it's mainly the sphere of institutional investors. But retail investors are also coming on board, with HSBC surveys showing 80% of investors want to make ESG central to their investing strategy. Sectors that are attractive in Southeast Asia include renewable energies, particularly solar and wind.
Our estimates were about $15 billion of new dedicated investment from non-governmental sources has been committed since the end of 2020. And over half of that in the last 3 quarters. Now that, of course, cuts across many different sectors of the economy. Corporates have been the largest investors with about 80% of that, which has been primarily going into the renewables as well as the mobility sector.
Financial institutions are gearing up to meet this challenge by ensuring staff have the expertise to guide new investors.
ESG investing is actually not that complicated. At the heart of it is really a spectrum. On the one end, you want to kind of exclude companies that might not be aligned to your values, whether it's tobacco or even weapons. And on the other hand, as you move towards it, you want to integrate ESG into your investing. So you want to look at companies that score well on ESG factors. And of course, on the other spectrum, you also want to look at thematics, long-term themes, such as energy transition.
But choosing the right companies can be tricky because of the lack of high-quality data which is used to assess a company's ESG credentials.
ESG disclosures today are largely historical self-disclosures done once a year. And besides that, there is no independent ongoing data that reflects how a company is doing on an ongoing basis, and hence investors are not able to manage the risk of their portfolio on a real-time basis. And besides that, data usually comes only from the larger companies, so there's a lot of missing data gaps in the supply chain or in the portfolio of any company.
That's where the ESGpedia comes in. Developed by fintech firm Hashstacks in partnership with the Monetary Authority of Singapore, it's a registry that aggregates data such as ESG certifications and carbon credits, a one-stop shop for investors and financial institutions to have better oversight over investments.
So, a lot of this data is non-digital and are in various parts of the industry that is not captured by the financial sector today. But the good news is that a lot of it is already available. So what we've been able to do is to aggregate this data from traditional industry platforms. So this includes your fleet management providers in the logistics sector, building management systems in building management, or the plantation or factory facilities, which is in the manufacturing or agricultural space. So we are able to connect this data directly to our registry and thus provide an ongoing view of any company's ESG performance. On top of self-disclosures, we also partner and integrate with IoT platforms and remote sensing directly at source. In other words, companies have no way to make up the data that they send to us.
Another challenge facing the sector is the perception that investors need to sacrifice returns if they want to consider ESG factors in their portfolios, especially when oil and gas is enjoying a resurgence in the stock market. Shares of the world's biggest energy majors have outperformed every other sector since the start of Russia's invasion of Ukraine. Shares of Exxon are up more than 40% since the start of the year. In contrast, the S&P 500 is down. But proponents say this is just transitory. In the 7 years leading to the pandemic, studies showed that the top third of companies ranked by ESG ratings outperformed the bottom third by more than 2.5% each year.
In some ways, ESG investing so far has gone through kind of a golden first chapter, where there were convergence of factors that nicely sort of lined up to make it very attractive. Some of which was, I think, the fundamentals about kind of the early stage of beginning to build many of these new industries, but also the fact that we've had, almost, a decade of extremely low energy prices, and many other sectors that might have traditionally competed for capital have been very poor investments. And now, suddenly we're moving into a new phase with, of course, the unfortunate events in the Ukraine this year, rising sort of inflation in petroleum and sort of, food prices and other sort of inflation, which is, creating a comparison between the relative returns in one asset class, which are sustainable and the things that we're looking to sort of seed and sort of fund, versus the old economy that is there, which is having a bit of a sort of resurgence in terms of its equities and its share price and its returns. So I think there are more, difficult choices now for sort of investors, particularly, ESG managers and the like, as to how they kind of, balance the two.
Ultimately, it's early days yet. But experts say a company which pays more attention to ESG factors is more likely to be resilient and therefore better positioned to weather the uncertain conditions ahead.
In terms of risk management, I think that on the risk side of things, it's clearer. In terms of companies that score very high on ESG, do better on a risk management basis because they are less prone to reputational risk associated with environmental breaches or even labor rights issue. In terms of performance, if you stretch out over the long term, the differences is much more clearer. You see companies with stronger ESG practices outperform in terms of financial matrices, whether it's earnings, profitability. But of course, if you look at share price on a very short-term, day-to-day basis, that will be harder to tell. So I think you have to kind of take a step back and look at it through a longer-term lenses.